A lot of people want to buy life insurance when they unfortunately become uninsurable due to medical reasons. So the best time to buy life insurance is when you're young and you're healthy. And so a lot of people will ask me, Cynthia, what is the difference between term life insurance and whole life insurance? Because I sold life insurance for 4 years, and the insurance that I sold the most was actually whole life insurance. So I'm going to explain the difference between the two. So term life insurance is always the cheapest, but now when you buy it in a term length. So typically the amount would be 10 to 20 years. That's a typical term insurance policy. And typically term insurance, you cannot have past the age of 65. So term insurance is really good if you have a mortgage. You can get term insurance to cover for that protection. Now, the only thing is with term insurance that a lot of people don't like is after the end, there's nothing left. So all the money that you've paid into your term insurance, kind of like renting, is essentially gone. Now, whole life insurance is a lot more expensive, but it's permanent coverage. And you can get a policy for 10 to 20 years. And after the 10 to 20 year period, it's considered paid up, which means you're not going to have to make any more payments after that, and then you own the policy. And the nice thing about that is, let's say, for example, you purchase a $100,000 whole life insurance policy. That policy is going to continue to grow. There's a minimum amount, they call it a dividend interest rate. There's a minimum amount, and typically it's 2% that you will get on top of that, but some insurance companies will give you up to 4 to 5%. So you will earn some money on top of that policy. So let's say, for example, your $100,000 has now grown to $150,000 20 years later. Now you've paid up the policy, you own the $150,000 insurance coverage. You can also borrow against your policy in the form of a policy loan, and then you can buy other things with that. So a lot of people will utilize a strategy called infinite banking, where they'll borrow money off of their policy if they want to buy a car or if they want to buy a rental property. So you take it off of your policy, you borrow against your policy, and then when you make your payments back, instead of making the payments back to the bank, you're actually making the payments back to yourself. And so essentially what you're doing is you're utilizing the dollar more than once. So that's a nice thing. And then if something happens and you pass away, then what happens is they just take the policy amount, the policy loan amount, and they deduct it off of your policy, and then they give your beneficiary the difference. I'm Cynthia, and I help people just like you increase your financial IQ and help you on your path to financial security. Don't forget to like and subscribe, and we'll see you in the next video.